Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com looks at the major markets and tells us that gold put on a good show over the week. He also has an update on crude. Eric Hadik, president of InsideTrackTrading.com, takes a gander at the 40-year cycle that has governed major conflicts and how that might affect the markets. Will new highs on some equity markets continue? Ted Dixon, CEO of IncResearch.ca, points out how stalled energy projects in Canada have cost the country tens of billions and why tax reform is needed to give our economy and your pocketbook a boost. Plus, at the end of the show, we'll have company showcase updates from American Manganese president Larry Reaugh and Naturally Splendid founder Craig Goodwin. We'll talk to Ross Clark right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Good to be with you, Jim, and Easter's behind us, and now we're looking forward to some warmer weather, unless you're in the prairies. They're talking about snow this weekend.
Well, welcome to Canada.
Yes.
Ross, the screens were green to end the week, but not by much.
No, it's been, markets are just, they're crawling their way up here, depends upon, what sectors you're looking at. Some of them are doing pretty well, but broadly speaking, the indices are, say, into new highs, or challenging them, as it might be in some cases. But individual stocks are having some pretty big swings. The earnings coming out this calendar quarter, it's not unusual to see 5 or 10% moves in some of these stocks. Ford was up 11% on Friday. Intel's on the other side of the coin. It's down 10%. So, if you're in a fund or an ETF that's broadly based, you might not have seen too much action this week. But if you're looking at individual stocks, there's been a fair amount of excitement.
Gold, was that a mover this week?
Gold is, I'm really happy with what we're seeing here. We were expecting that we'd have a correction, a two-stage correction. First leg down happened about a month and a half ago off the seasonal high in February. We got a nice bounce, and then as of this week, it's tested the 50% retracement level of the whole rally from the August low. And April tends to be a very important month in that if you've been in an uptrend, you have this correction, it needs to hold at that 50% retracement point, which is around 1265 as far as bullion is concerned. The intraday low was just over 1267. Had a good bounce into the end of the week, up to about 1280-ish or so. Now, this becomes very, very important from a seasonal perspective, because if you take out the lows that we put in this week, as we move into May, you will normally see pressure right through until the middle of June. So this was a tradable low this week for the miners and for bullion, but it's a time that you want to have a pretty tight stop in here. If things start to turn against you, don't overstay your welcome, because if we do start to take out these supports, we've got quite a bit still underneath us in terms of, I would say, open space for the downside.
Is there any action in the miners, the junior gold miners?
The miners overall, some of them had some pretty good bounces as we finished off the week. Most of them have been down pretty hard the last 2 weeks. They got to their, depending upon how strong they've been. And a stock like Kirkland Lake, which has been one of the winners on the upside, it just came back to its 20-week average and bounced nicely. Other ones that have been more of a methodical move got down to their 50-week averages, which is where you'd expect to find support. 50-week, 200-day, one and the same. So the GDX, the GDXJ ETFs, those look like they've probably got a little bit of staying power here for the next couple of weeks. But as I said, with bullion and with these miners, if they don't really gain some traction here, don't look to be for traders at least. Don't look to be sticking around for too long.
On the currency side, how's the U.S. dollar doing versus Canadian?
Well, Canadian actually had a bounce back at the end of the week here. We've been of the mindset that the Canadian dollar is in a pretty solid downtrend, having minor rallies. It'll rally a cent and a half off the lows and then start to erode its way back down. And during this week, we ended up closing off the week at a new low for the last couple of months, now down and approaching the levels that we saw back in the first quarter of the year. We've had it's been weighed down because of both the interest rate differential against the U.S. in terms of short-term money and the heavy markets in terms of the agriculture area. When you look at wheat or corn or canola prices, they've been under quite a bit of pressure. So that's been bad for the currency. The oil market was on the other side of the coin. We were up to $67 or so in the oil market, with a $12 or $13 discount on Western Canada Select. So the Canadian dollar should have had a better performance with the underlying support from the energy side, but without it having shown that resilience, we still think that the easiest move here for the Canadian is to go down and take out the lows of it, at least earlier this year, and very likely the lows that we saw in 2017. So that's for unless you see some really significant move through the highs that we had about 5-6 weeks ago. Trend is still down, and there's no reason to be playing the long side of the Canadian.
Ross, what's happening in crude?
Well, crude, we've been looking for this seasonal high. The month of April, especially on the 9th year of the decade, is part of this 10-year cycle we look at. The optimum point for a high was going to be in the month of April. We had a good initial high here of a couple of weeks ago, small pullback, and then a higher high this week into the middle of the week. But we had a really good divergence as far as the relative strength index is concerned, and that's exactly what we see when we look back at these other seasonal highs, 2009, 1999, 1989. This is classic. And so right now, we're going to be looking for a correction down into the mid-50s, probably the $54 to $56 range. That should provide just an optimum buy as far as the oil market is concerned, and the oil stocks, and especially these Canadian ones, which showed some resilience or showed some good buoyancy here in the last month or so. The last couple of days, starting to see pressure come into place, which is good. We need to have a bit of a clean out. If they were to give back the 50 to 60% of the run-ups off the bottom, we've got half a dozen names that we're going to be very interested in.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
We're speaking with Eric Hadik, CEO and president of InsideTrack.com and InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, a number of equity markets hitting record highs again. Was this predictable when we had that huge dip that started just before Santa came to our houses?
Well, there were certainly some key stocks and related indexes that provided some divergent signals at the late December lows. One of the things that I wrote about in early January was a monthly trend pattern that I use, and it applies to weekly and daily trends as well. Same pattern, just on different time frames. But it's something where, in my work, a market cannot immediately go from up to down or down to up. It's got to go from up, then to a neutral status for at least 2 periods, and only then will it be in a position to turn down if it was previously in an uptrend. So all that to say, as we were coming into the December lows, I was discussing my monthly trend, kind of the biggest time frame of that trend indicator I watch, and how there were several key stocks, many of the tech stocks that had led the advances last year, Microsoft, Google, Amazon, that had given a couple of neutral signals but were not able to turn their monthly trends down. And when you see that happen, it usually projects a rally back to the previous highs, which those stocks were at that time forecast to do. So an indicator like that gave me a good viewpoint on 2019 and how several of these indexes and stocks should set new highs, while others are very likely to set lower highs and create the kind of divergence that you often see at a major peak as it is unfolding. And so those things were discussed back then and have been part of the focus ever since, along with the timing and cycles that all focused on May of 2019 as the most likely time for that peak to arrive.
Now, with those predictions in hand, can you tell what's going to happen over the next few months?
Well, I think that we're going to see pretty much what was just alluded to there, some peaks set near their previous highs. In some of those key stocks, it'll be higher highs. In other ones, it will be lower highs. And then some selling materialized, but more than anything, I think it's going to be some volatile, two-sided trading throughout the end of the second quarter and part of the third quarter, where those stocks, especially those that haven't set new highs, continue to find resistance back at the 2018 peaks. And you see a steady, gradual rollover during the ensuing months, the months that follow May of 2019.
Is this going to be one of those sell in May, go away years?
It certainly could be for a few months' time, which really is what that adage refers to. It's usually selling in May and then coming back in the fall when everything comes back to life. And so it wouldn't surprise me at all to see a seasonal structure like that to the equity markets. And it's just intriguing to me that these overriding cycles that have little to do with that annual seasonality are showing the same thing. In fact, one of the most consistent cycles that I've seen in the equity markets over the last 5+ years has been an 8-month cycle that usually breaks down to 32 to 34 weeks. And in early 2018, I mapped out how I thought it would create an important high in late January of 2018, and then another one in September of 2018, and then looking forward from there, a subsequent high in May of 2019. We saw the two in 2018 in January and then in September take hold with successively or progressively sharper declines following each one. But both of them projected this focus to May of 2019. And so that 8-month cycle just continues to unfold. And the other intriguing part of that is that same 32 to 34 week cycle has been just as uncanny in timing turning points in the energy markets and in crude oil, which have turned, their intermediate turns, their turns that are of several months or longer, have been in close lockstep with the equity markets over the last couple years.
Agricultural commodities, how are they going to be affected by that huge flooding that's hit the U.S. Midwest? Some people predicting it could even cause food shortages.
Well, it will come down to certainly planting and where and how the farmers choose to allocate their acres and their crops. But unless you really see this type of thing continue to play out in the coming weeks, it might be a small blip on the radar. So I really don't know how that will play out in the coming months.
Because springtime flooding somewhere, somehow happens every year, is that just part of the natural cycle that you take into account?
Yeah, and it also does often impact crop acreage, so it will often be bearish for one crop, bullish for another, depending on if that flooding pushed farmers past the sowing dates for one crop, and then they're forced to opt for an alternative. So you do see those type of swings and seasonality, but it usually takes more than one challenge like that to really have a lasting impact on price. And there are some longer term cycles that have been watching, focused on 2019 and 2020 for a surprising up move in some of the grains. So I am certainly looking for other challenges to emerge in the coming months that could more seriously impact crop acreage.
When you said some grains, do you have any particular ones in mind?
Well, soybeans are one of the ones that have really had this consistent cycle that focuses on late 2019, early 2020 for an important peak, but also the culmination of a serious uptrend. So, I'd expect to see them bottoming in the very near future. Corn has had an overlapping cycle that's offset a little bit from soybeans, but both of those are in my focus. And wheat has its own rhythms that it ebbs and flows with, but it is also close to the time when it should be entering more of a bullish phase. But I need to, because they're broader cycles, there's a lot more specific indicators and technicals that I would need to see start to corroborate that broader analysis before I would start to turn bullish on those.
We'll have more with Eric Hadik when This Week in Money returns.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, on the energy front, how is crude oil doing, and what do you expect it to do over the next year?
Well, like I mentioned in our discussion on the stock market, crude oil and the energy complex has also swung very consistently on this 32 to 34 week rhythm, and that helped pinpoint the late September highs of 2018. And as that was unfolding, now that at that time there was also a 5-year and a 10-year cycle that were all saying we were at a major peak in oil markets. But when the sell-off from there was reaching a bottom in late December, I started discussing how that 8-month, 32 to 34 week cycle was focused on May of 2019 for the next peak, and that we should see a rally from that late December low into May of this year. And crude has continued to adhere to that outlook, and has, after turning its intermediate trends up early in the year, has continued to reinforce them. But it's getting up to 6 to 12 month upside targets. It has given some strong wave objective fulfillment. And so there's a lot of things starting to say that it's getting near a what I expect to be a multi-month peak, and that there have been shorter term rhythms and cycles that have reinforced the broader cycles, and been saying that we should see this type of peak take hold in May. So there's some reasons for me to start looking for signs of a top, but there again, it's something where price action needs to validate those cycles and needs to start giving warning signs of a top. I think there is still potential for a little more upside, but another thing that I look at in the markets and in crude is I have these extreme upside targets, I call them. And when a market is able to reach them, which on the upside, on a weekly basis, it might be able to reach its weekly extreme 1 out of every 10 weeks. And crude has just done it 2 of the last 3 weeks, which is a sign of a strong uptrend nearing its peak. Usually those extremes will be hit within 1 to 3 weeks of a multi-month top. So it's something that's showing the culmination of maybe not a parabola, but an accelerated advance, and it's warning that a top is near at hand. So I'm seeing some of those type of indicators also show up in the oil markets.
What about cryptocurrencies?
Cryptos, I've discussed how it's been very surprising to me for the last 2+ years that Bitcoin has really held strongly, closely to some cycles that it identified. And the most recent was back in mid-December. I did some cryptocurrency war reports that explained why mid-December should be a major bottom, and compared the action in Bitcoin in 2017, 2018 to something like the NASDAQ 100 back in the 2000 to 2002 time frame, when it was a bubble that completely burst, but that didn't mean that it was a market that was going away. It meant it was a market that had gotten so far ahead of itself, needed to return to a point of equilibrium. And throughout 2018, I had identified that equilibrium point being around 3,200 in Bitcoin, after it getting almost 20,000. And in mid-December, it finally reached that. And again, if you look at the parallels between Bitcoin's action in 2017, 2018, and a lot of the dot-com stocks of the late 90s, early 2000s, it was a very similar pattern and very similar proportions as to how much of the parabolic move was erased and corrected. But that, along with a lot of other things, told me to start turning bullish on Bitcoin. And then I published a follow-up to that in mid-March and reinforced the buy signals that were already in place and explained why I thought we would see a strong rally from mid-March into June. And that's still in force, and I think that the next surge in cryptocurrency could be if the dollar peaks out here and starts to retrace a bit. Often you see kind of opposition correlation, inverse correlations like that kick in midway through a trend. So even though Bitcoin has been building a base and starting to rally, it could get a kickstart or an additional surge out of the dollar turning down, which I think that May through July could see some selling materialize in the dollar.
Where do people go if they're not going to the U.S. dollar?
Well, obviously, cryptos has become one of them. Gold is often one of them. Or if it's just a matter of moving money between currencies, it would depend on which one happens to be the focus or the more in vogue currency with investors. So I think there's a mix of that. I described one time how with your anti-dollar vehicles, and those could be classified as your fiat currencies, your hard assets, mainly precious metals, and now your digital currencies, that all three of them are often vying for the anti-dollar moniker or the funds from your anti-dollar traders, and so you often see some competition between them. And even recently, you've kind of seen that where gold had a strong rally from mid-August of last year into late February of this year. And at the time, the dollar had peaked in November and really has held at or slightly below that high ever since. In the last couple of days, it just spiked a little bit above it, but it is still, for all intents and purposes, right near that November-December high. So as that was just vacillating near its highs, gold was picking up steam. Meanwhile, cryptos had that sell-off into December and then just kind of were basing from December through February. Then all of a sudden, when gold reached its peak and reached some very significant cycle highs in late February, started to turn down, that's all of a sudden when cryptos and Bitcoin started to come back into favor. and Bitcoin saw a good surge. So it's that volatile back and forth competitive moves between all of those financial instruments that you see, and there can be different fundamental reasons why investors are flocking to one over the other, but that's just an ongoing competition between all of them.
We'll have more with Eric Hadik when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, is there kind of a generational battle between investments here when you look at people investing in Bitcoin? Are they the same people who invest in gold, or is it older folks who look at gold as a safe haven, and younger people really love their computers and handheld devices, and they might just pick cryptos because it's something they're familiar with?
I think that's absolutely the case from a general perspective, and even more specifically that has been the case, and it factors into very closely this 40-year cycle of currency wars that I often come back to discussing. And that's something dates back to the beginning of our country, even in the 1770s, in the early 1780s, you had the Continentals issued and ultimately collapsing. And every 40 years since then, you've had this battle between paper, fiat currency, hard currency, primarily gold and silver. And now this last phase of that 40-year cycle has been the introduction of digital currency. So I think you are having that generational battle, as well as the battle I just described between the different anti-dollar vehicles. And I think that's going to continue to play a role. And that there's going to continue to be skepticism where digital currency is concerned from the older generation, the more set in their ways. But if you look at the history of precious metals-based currencies, they've had their own challenges and their own struggles every time it's been implemented. So even though theoretically there's an argument for it as far as the accountability and stability of the currency, there's also a lot of things that have doomed it almost every time it has been implemented. So that battle is likely to continue to play out, and in some ways that also reinforces the parallel I was just speaking about between Bitcoin and cryptocurrency versus the dot-com bubble of almost 20 years ago. The internet and the dot-com stocks were in their infancy, and who was to say what potential they had at the time? It certainly was your younger generation that saw the future in the internet, but it took some time for it to really be able to mount a steady, sustained advance.
Right, and of course, the whole thing about .com was you knew it was the hottest new trend, but you didn't know which one of them would survive after thousands of .coms popped up, millions of them.
Right, just like the dozens and dozens or hundreds of cryptocurrency we had over the last couple of years. And, when you start getting something like that, that even goes back to when you hear things described in the 20s of all the shell corporations and the stock funds of stock funds of stock funds, basically. The market has to clear out all that noise and all those weak hands before it can really start to mount a steady, more sustainable, more authentic bull market.
Eric, now being a cycles person, I know in the past we talked about war cycles. Where are we in the war cycle, and what should we be looking out for?
Well, I think there are a couple of pretty intriguing things that have occurred just in recent weeks that play into both long-term and short-term cycles of conflict. And let me break them down into two separate things since they are distinct cycles that I talk about. But one is the annual, what I describe as the month of aggression, week of aggression, and date of aggression. Very quickly, the month of aggression I describe as that first month of the natural year, starting from the vernal equinox in March 20th, 21st, and culminating on April 19th, 20th. And then the final week leading into that April 19th date, and then the date of April 19th, have been such a historic timing of conflict and terror attacks in recent decades. And that cycle goes back, as I've detailed, in the U.S. at times, the first shot in the Revolutionary War, the first shot in the Civil War, decisive events in the Mexican-American, Spanish-American, even the culmination of the Vietnam War, all coming right around that same date. And in recent decades, it has been a date that has timed attacks and conflict from Waco to Oklahoma City bombing to Columbine to the Virginia Tech shooting. And this year it was the Sri Lanka bombings that we just saw coming on April 20th, 21st that just reinforced that constant attacks and that cycle, especially that month of aggression that I referred to, dates back millennia. You read in the Old Testament and talking about the time each spring when kings went off to war, and it was describing that exact time frame. And you go back to ancient Rome and the celebration of Tubilistrium, if I'm pronouncing that right. It was an annual. It was a celebration to the god of war, Mars, and had a lot of bloodshed and was an all-out war celebration, basically. And so that is a historic time on an annual basis that has seen this uptick in attacks and in conflict, and that was just reinforced this last week. But looking at the broader war cycles that I've talked about and describing this 80-year cycle that has timed conflicts, I've documented it back to the 1300s, but has timed America's major conflicts from the culmination of the Revolutionary War in 1781 to the onset and entry into the Civil War in 1861, and then the entry into World War II in 1941, and looking ahead to 2021 for a potential for another conflict. And one of the things I've discussed in regard to that has been the obvious escalating conflict where China is concerned, and that for several years China has been getting their ducks in a row, both economically and financially, with things like the Asian Infrastructure Bank and their role in the New Development Bank from the BRICS countries, to the Shanghai Gold Fix, and at the same time, also building up their presence in the South China Sea and basically preparing to take over that entire region. And just in the last week, there's been the revelation and the discussion of the conventional missiles that they claim to have perfected that could really impact our aircraft carriers in the region and even force them to withdraw to a distance where that would be beyond the ranges of the aircraft, making them somewhat impotent in any potential conflict surrounding the South China Sea. You see things where Taiwan is concerned every couple years, a little bit of an escalation there, and it's almost like things are just that China is a very strategic nation and is just getting their ducks in a row for when they want to move on things like the South China Sea, and so on a very cyclic basis, these events are coming to light one after another after another.
Mm-hmm. Now, how does that affect people and their investments?
Well, I think something like that is until it comes to the time where it's really turning to the forefront and you start to see an acceleration of events that those investments, it's next to impossible to play off something like that unless you're really trying to play things out for a decade and anticipating foreign currency impact of something like that and different defense stocks. That there's so many different things, and all it would take is one little shift in the tactics to suddenly have you having to revamp your entire portfolio. So I don't think that on a specific basis that there's a lot to do where that's concerned, but again, as usually with events like that and with cycles like this, it's the very culmination of those cycles when things start to come to light and you have your biggest moves. You know, even when we've referred to the moves in Bitcoin and the moves in the NASDAQ 100, 80-90% of those moves happen in the final 10 to 20% of the cycle, both on the upside and then on the downside. So it's more being aware of those developments and kind of having your radar up, and then looking for when opportunities present themselves.
Do people rush to gold when these conflicts happen, if it's a major one?
Well, major ones in the past they certainly have, but the last 20 plus years when you've had regional conflicts like that, even ones that threaten to pull in a lot of countries, including the United States, gold it's been a mixed bag, and so it depends on what the focus is of traders at that time. If some of those conflicts initially have investors moving into the dollar, which has been the case in the past, that sometimes suppresses gold's upside potential. But I think that the way that the cycles I've described in gold, the way they're lining up, I think we are going to see a solid move up. I did some reports back, one of them in September of last year, that described longer-term cycles in gold and gold stocks and why the third quarter of 2018 should be a major bottom and that should start a bull market that lasts into late 2020 or early 2021. So it certainly is conceivable that those cycles and some of the expectations I have for precious metals could be impacted by some war drums rumbling at some point in that time. But for me, the fundamental driving force doesn't matter when I'm first getting into a market and seeing a trend that is developing. Usually those fundamentals materialize about midway through a trend. So either you've recognized it on the charts and with cycles and have positioned for it, or you better move very quickly when the fundamentals come to light, because that's when everybody's rushing to get in.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim. Always a pleasure.
My guest has been Eric Hadik, CEO and President of InsideTrack.com and InsideTrackTrading.com. He was speaking to us from the Chicago area. Coming up, Ted Dixon, next on This Week in Money.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 2018 Fund Data Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Well, it's great to be back, Jim.
Ted, do you have a feeling of deja vu that it's 2018 all over again in Canada?
We do, Jim. We just put out our weekly Insights newsletter on CanadianInsider.com, which is available for free. You can get it through our blogs or the Market Center on the website. And the latest edition is called 2018 Deja Vu, because what we're seeing in terms of insider activity is almost exactly the same as what we saw last year. Now, last year, what happened, we saw our Inc. indicator, which measures the amount of stocks with insider buying versus selling, which is a sentiment gauge on insiders. We saw that indicator dip and flatline pretty much starting in May, heading into June. And that coincided with an all-time high in our Canadian Insider Index. That's a mid-cap-oriented index of Canadian stocks. It hit its all-time high of 1319 on June 13th. Right when our indicator was bottoming out and flatlining. And guess what? We're seeing the same type of behavior now, except it's happening a bit earlier. It's already April, and we're seeing our indicator bottoming out. But the Canadian Insider Index is still 13% off its highs. So this is a bit of a concern in terms of what we're seeing right now. It's sending a pretty strong warning sign that there are likely risks ahead here. Does it mean we're going to have a repeat of 2018? It could, but it could also mean consolidation, or maybe it's just a false signal. We'll have to see, but it's certainly something to keep an eye on. There are differences, of course, between 2018 and 2019. A year ago, we were worried about a trade war with China and the U.S., and now we're talking about a trade deal. The Fed was hiking back in 2018. Now it's on the sidelines. So those are two positive developments. We're also seeing oil move up here, which is positive development if it's demand driven, if it's the global economy wanting more oil. But if it's supply driven due to politics in OPEC and supply problems in Canada and perhaps some pipeline constraint problems in the US, well, that's not quite as positive. So we'll have to work through these mixed signals here. but for your listeners, I would certainly take a look at our newsletter and get an assessment of what the insiders are saying and kind of our take on things. But something to keep an eye on for sure going ahead in terms of what we're seeing in Canada.
Ted, few buyers for U.S. transports. What does that tell us?
Right. Well, this is the American side of the story, and it's very similar to Canada, if not maybe a little bit stronger in terms of its warning signal. And I just put out a blog post today on what's happening in the transports. And basically, transport insiders are jumping ship here, Jim, in terms of this market rally. We have a transport indicator that looks at the transportation industry in the U.S., what insiders are doing. And over the last 2 months, we have seen zero insider buying of any note. It's all been selling. And I can't remember the last time we've seen that. So this is an even bigger warning sign than what we're seeing in Canada, because if you take a look at the blog on CanadianInsider.com, you'll see our indicator, our transport indicator. It was this transport group of insiders was very savvy last year, Jim. They were selling last September when the Dow Jones Transportation Index was hitting its all-time highs, and then they were buying again in December. So they were pretty good at spotting adversity and opportunity last year. And right now, they're basically out. They're out of the market. So this is not a positive sign by any stretch of the imagination. You know, are they just being too nervous? Are they just signaling heightened risk? You know, could the U.S. market keep sailing here onto new highs? Sure, it's possible, but we're seeing a real reversion back to the old Obama, Yellen, Bernanke playbook, where investors are piling into growth-oriented stocks in the U.S., stocks, like Microsoft, Amazon, Facebook. And why that's so concerning is that those are what we would call idiosyncratic growth plays. These are plays on the individual companies. And why is that a concern? Well, it's a concern in that investors are favoring individual stories as opposed to going for these sort of broad value plays that would be reflective of a strong economy, a global economy, sustainable economy. Investors are instead going back to the old playbook. And the difference this time with that playbook is, of course, there's no QE in the U.S. right now. Rates are not at zero. So we'll have to see if chasing, Microsoft and these other large cap stocks, high multiples, the large cap multiple trailing PE multiple in the U.S. is about 22. With rates no longer at zero, we'll have to see if that plays out. But that's where investors are going, and it's something to be mindful of in terms of strategies going out there. At the very least, Jim, I think investors are going to have to be very, very razor focused on stock selection, and not to expect that we're going to see these sort of broad highs across all the different areas of the market. Really, we're starting to see these large cap stocks lead the market higher, which is what we saw last year, and we saw what happened in the fall of last year and late fall. So something to be concerned about for sure. But look, it's early. We're still in spring, and things can change. So we'll have to just keep an eye on those different indicators and see what happens from here.
The Bank of Canada and the U.S. Fed have both signaled now that we've pretty well seen the last of interest rate hikes. How does that affect the economy?
Well, it affects the economy by helping to keep credit growth level, at least. It's not going to choke it off in terms of central bank action. Now, whether there's demand for credit organically, like whether businesses see the need to go borrow money to take advantage of investment opportunities, is a whole different story. So you've got the central banks trying to at least keep things going here by not making the economy, the credit conditions more restrictive. Whether it's enough to keep the stock market going, we will have to see. So far in the U.S., it seems to be working, but how much longer can the U.S. market keep going without rate cuts? We will have to see. Certainly, you want to look at those stock situations that would benefit more from this type of Fed on hold, Bank of Canada on hold environment, keeping in mind how the bond market's reacting. So we're really kind of getting into a complicated situation here where you've got to assume that we're not going to get any interest rate hikes on the short end, but are we going to see bond yields continue to fall? And if they continue to fall, then that would be a bad sign. You'd want to sort of move over to defensive stocks. But if you start seeing bond yields move back up again, that could indicate some inflation coming into the system. We're certainly not there yet, but that would mean something else. So it's really a tricky point here for investors going forward. And in terms of what we're telling our clients and our subscribers, that we're looking at stock situations, be very razor focused on stock situations in Canada. We've got an interesting, I think, dynamic unfolding in the marijuana space, where it looks like marijuana stocks have, as a group, are consolidating. Maybe have seen their peaks for the year. Maybe we've seen a sort of a short-term bottom here, but in the group. But generally speaking, I think we're looking at stock-by-stock situations. There's a lot of pot stocks, Jim, that are down for the count. I don't think a lot of those ones that have underperformed this year are coming back. There'll be exceptions here and there, but generally you want to look at the ones that have a good management, of course, good business models. And on our Canadian Insider website, you can take a look at our Inc. Edge Outlook rankings for the larger ones anyways, and see how they rank compared to other stocks in the market. You really want to be stock by stock here, story by story, management by management, and don't count on sort of a broad move in any group at this point, for generating above average returns.
We'll have more with Ted Dixon when we return.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ted Dixon. Ted, does the marijuana sector look to you the way the .coms did? A lot of promise, a lot of prospects, but gosh, a lot of them just blew up and disappeared.
I think there's a big difference between the two phenomena in that you've got a underlying demand that is likely going to grow over time, but figuring that out is going to be tricky, but it's going to provide opportunities if you can get it right. Whereas the .com phenomenon, it was a mania that there were the broad assumptions that every part of the economy would be taken over by the internet, whether it was, grooming your dog or, buying medicine, or everything was going to be destroyed and rebuilt by the internet. Where in the marijuana sector, it's really a lot more complicated, and I think that's good in that investors, I think, are starting to getting their heads around that now. Whereas maybe a year ago, there was before legalization, there was an expectation that a rising tide would lift all boats. I think investors have come to grips with the fact that they've got to be a little bit more sophisticated in terms of seeing which stocks are going to win and lose. And I don't think we saw that in the .com era. I think in the .com era, everybody was piling in, and then everyone left. In March 2000, everyone started to sell. Whereas in this case, I think you've still got a lot of believers in the group, but they're getting more sophisticated, which, kind of surprises me. I did think that maybe we were heading for a bit of a .com type of situation a year ago, but given how investors have responded to the changes in the market, and what I'm seeing on CanadianInsider.com in terms of where people are looking and the reaction to different stock stories. I think investors are getting a lot savvier in the space, so it could be very interesting. It's going to be a very interesting story, but there's going to be a lot of losers, and I think investors are starting to realize that, and they're dumping a lot of stocks that aren't performing and don't seem to have their act together. So from that sign, that perspective, it's a healthy sign.
Is there much action in Canadian mining juniors, especially gold?
Well, this is another area that we would put down as sort of an idiosyncratic growth play in Canada. What I mean by that is, in the U.S., of course, you've got these big tech companies where you're betting on certain, Amazon with its cloud business, Microsoft with its cloud business, Facebook with its social media platforms. In Canada, on a much riskier scale, you've got some mining situations that are developing that, for those with very high risk tolerances, can look at situations such as the James Bay area that you hear about on Discovery Watch that are really independent of global economic growth. So if you get a major confirmation of discovery, the James Bay area in the Mithril project that Midland Exploration is going after, if you were to get that to work out, then that would be completely independent of what's going on in the global economies. But it's very dependent on what goes on in the ground in James Bay. You also have similar situations going on, maybe in smaller scale on the gold side in Ontario, in the Red Lake District. There's some plays going on. There's a play going on there right now. Great Bear Resources. So there's a couple of mining plays going on that are not dependent on global growth and offer opportunities for speculators. It's certainly a speculative type of investment. But Jim, let's face it, if you're chasing large cap stocks in the U.S. that are trading at multiples over 20, you're taking a fairly speculative approach there. I mean, I'm just looking at Facebook right now, and its trailing PE is 25. So you're really betting on Facebook that it's going to be able to overcome all its issues and continue growing its platform. That's a leap of faith. Is it as big of a leap of faith as getting good drill results out of a hole in a mining play? Well, not quite, but they're just different degrees of speculation, I would argue, and certainly mining is the most speculative. But look, we're in that kind of a market environment. It seems now that people are chasing growth again, and it would be good to see a nice rotation out of that situation into a more broader-based, value-oriented market, but that's not happening this year.
We'll have more with Ted Dixon when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ted Dixon. Ted, China plans to ban the mining of cryptocurrencies on May 7th. Is that going to send a shockwave through the cryptocurrency community?
Well, I guess it depends if they enforce it. There's a lot of rules in China that are on the books but that aren't enforced. So we'll have to see how that plays out. I really think that the cryptocurrency space will be driven by other factors, very similar factors, I think, to the gold market. How much confidence do investors have in the current monetary system and monetary environment. So long as there's an acceptance of the U.S. dollar as a reserve currency, I would be surprised to see cryptocurrencies really break out of their current range. Anything's possible, of course. If we start getting rate cuts, that's another story. But I think the cryptocurrency space is now a longer-term investment area that's really going to take a lot of figuring out in terms of where it all fits in a possible longer-term redesign of the monetary system. And now we're talking years and years, I think, unless some sort of geopolitical event, economic event accelerates that process. But right now, I just think it's a slow march to the eventual realization that the current monetary system, and what I mean by that, this infatuation with 2% inflation targets and having central banks, believing that they can manipulate the economy and steer the economy. Eventually, that's all going to get unwound and undone when it's exposed, that it's all a mirage. But that's going to take a long time, unless there's a major event that happens, to hasten that process, which I can't, certainly predict, but it's possible. But so in the meantime, I think, the cryptocurrencies kind of work through their own individual idiosyncratic characteristics and benefits. Every cryptocurrency has a different story to tell, and eventually I think you'll have one or two of them, maybe three or four, emerge offering a value proposition. That's, I think, the real story in the cryptocurrency space, and it's not a space I think is dead by any stretch of the imagination, but a lot of the stories in that space are dead and falling by the wayside, and that we're in the process of shaking that out. So I don't see China, to answer your question, as really being a major determining factor in sort of the longer-term trend in the cryptocurrency area.
The Fraser Institute has just completed a study that says tax regulations in Canada have increased by 72% since 1990, and they did things like how many pages is it? How much do the pages weigh? How many words are in them? And now it's virtually impossible even for the simplest tax regimen to be done without a computer and a software program as well. What has this done to the cost of business?
No kidding. Well, kudos to my old employer, the Fraser Institute, for getting back to its roots and tackling that issue. First of all, the whole concept of income tax should be revisited, Jim, because as a government, you really want to have a pecking order of taxes in terms of what you want to use the most. And in this pecking order, really, you should be at the top of the list in terms of what you want to tax. You should be taxing behaviors you want to discourage. And creating income and creating wealth when you've got an aging population, an aging workforce, should not be at the top of the list. Yet, through inertia, through a bunch of really cowardly politicians, and I think you can apply that to both political parties, although probably one party more than the other, that political parties, Jim, in this country are driven by focus groups and polls. They like to go after emotional issues such as immigration, things like that really don't require any hard economic decisions. If they can run an election campaign on an emotional issue that has nothing to do with economics, they will. And that's just the nature of our first past the post system, and it's not unique to Canada, but that's the reality. And so you get this basically lousy economic policy that comes out of our political system. And this kind of gets back to the monetary remake that I think is going to eventually happen. I think we're going to have a remake on the political side, but it's going to take years and years, and whether I'm still on this planet when it happens, is another story. But, right now we have a system where we elect these representatives. It's a system that was designed back, when basically the printing press was the latest high-tech invention. So people were relying on newspapers, weekly newspapers to get their news. Well, things have advanced. We should really be advancing our political system and our electoral system to reflect that, but we haven't. So we get these lousy policy concoctions and budgets that have thousands of pages in it, and they use these budgets to slip in other things like, deferred prosecution agreements for large companies, right? That was last year's surprise. So, it's really a bit of a mess, and the income tax should be a lot simpler. It should be a lot smaller because you want people to go to work. You want success. And I'm sorry, for all the socialists out there who, are married to this romantic notion that we need a progressive tax system because it's the best way to ensure equality. I'm sorry, get with the time. That was fine maybe in the 1950s after World War II. Things have progressed. We're in a different situation. There are other ways to bring in progressive policies, and yet, what have we got in the U.S.? You've got you've got a socialist in the U.S. trying to counter Trump with really crazy, unaffordable ideas. Whereas, a thinking left, a thinking progressive party would be really doing its homework and looking at different ways to ensure equality in society, and taxing work. That is an outdated concept, Jim. If you're going to look at doing progressive policies, really, it should be on the consumption side. But look, no politician wants to touch a consumption tax because it's hard. It's hard to talk about consumption tax, and your opponent will just get up there and lie and get elected. And the opponent will then go and do, what we saw the NDP do in British Columbia, where they said, we're going to take off the tolls on the bridges. And then what did they do? Well, they stuck up the gas tax instead. So, they took from one hand and gave to the other, but people bought it. So, this is a problem with our first past the post system. It's not going to get any better. And unfortunately, as much as I would love to see a simplified income tax system, I'm not holding my breath for it. I don't expect the Conservatives will run on it. I would be thrilled if they did, but I don't think they have the backbone. They're going to run probably on immigration and the carbon tax, because that's what their polling will show that they have the best chances to win. Their priorities will be to get rid of the carbon tax, which is fine, but that's only part of the issue. When you've got this mess in the income tax system, it's a much broader mess that government has created. It should be one of the top things on the list to fix. But as I said, I'm not holding my breath for it to be fixed anytime soon.
Well, don't forget, Ottawa still hasn't fixed their Phoenix pay system, which has been around for 5 or 6 years now. They still have employees who aren't getting paid. So.
Right, and the vested interests in that are small compared to the vested interest in keeping the tax system where it is, because there are a lot of winners and losers in the current system, and the winners, you can bet, are screaming blue murder if you try and touch it. So you need a political movement that has some fortitude and ability to communicate why we need a change. And unfortunately, Jim, usually you don't get the public's attention or the backbone of a politician. You need both. Unless you have a crisis. And right now, we've been lulled into this sense of everything's okay, and there's no feeling that we have to make any changes. And when there is a crisis, then there'll be an opportunity, and at that point, there'll be a contest between the old style socialists who will propose bigger government, and the government will solve everything, and maybe some true reformists who say, no, there's a better way. We have the technology now to provide more democracy in the hands of the people, more direct democracy with safeguards for minorities, the fair tax system, and we will see which of those two approaches works. But I'm afraid we're going to have to wait until the next crisis to find out.
Well, People's Party of Canada leader Maxime Bernier, when I interviewed him, he said he's in favor of a 3-tiered taxation system. And he wants to get rid of government subsidies. He is a true believer in things like that. Is that what we need? Because, like he said, 19,000 dairy farmers are holding the rest of Canada hostage.
So one can only hope that Maxime Bernier has his day in really being able to talk about those issues. But unfortunately, you have the state-funded news agency in Canada called the CBC already, trying to do a hatchet job on him by focusing on immigration and trying to paint him and his party as a party of racists, which is the typical left-wing playbook. When the fact of the matter is, as far as I know, you've got the People's Party. They've said, here's our number for immigration. They're not saying no immigration. They're saying we have a number, and which is a fairly reasonable approach. I may or may not agree with the number they put, but when I hear Maxime Bernier say, we have a number, why isn't the mainstream media asking the Liberal Party what their number is or what Conservative Party number is? Because that would be too easy. It's much easier to kind of try and paint the People's Party as a racist party, and go and find one or two supporters who have not so great backgrounds. Well, you know what, Jim? I could do that. If I really was determined, in any political party, you're going to find a lunatic here and there, right? So, but this is the typical playbook of the left, and it's even worse in Canada now, because now you've got the Trudeau government is basically paying off the mainstream media with subsidies, and so there'll be a bias. There'll be an ingrained bias with amongst the major mainstream newspapers anyways, or what were used to be newspapers, against any form of cutting back subsidies, because their whole business models now will be dependent on government handouts. So, we're really, I think, set for this, we're on course here for a period of political, economic malaise. It's not just Canada, and I don't want to kind of overplay it here that this is a Canadian phenomenon. No. This is a Western democracy issue. The issues in Canada, if anything, are probably maybe, a little better in terms of being able to solve and haven't become so extreme, than in some other countries. So, let's not get too depressed about the relative positioning of Canada compared to some other countries. But the fact of the matter is, we're pretty much set on a course of unexceptional economic growth, unexceptional political reforms. It's just not going to be a very exciting time, unfortunately, for my kids, the way things are going right now in this country, or any Western democracy for that matter. I know there's a lot of hope around Trump that he would shake things up, but he's done, some good things. He's done some things that don't make any sense, on balance. We'll have to see if he gets a second term and where that goes in the U.S. But, the Americans have a lot of debt that they've piled up, on the back of their reserve currency status. Again, this gets back to the whole monetary system situation. So we'll see how sustainable the U.S. trajectory is. They have the advantage of being huge. They've got a relatively good free market. They've been the reserve currency, but they've really kind of leveraged that to the hilt. So, the medium-term prospects here, Jim, are not that great in terms of economic outlook. But eventually, maybe one of the best things we can have is a bit of a crisis to bring in some reforms that could really shake things up, at least for my kids anyways. I think until we get some changes, we're pretty much on a path here for unexceptional growth and unexceptional public policy. But it's fine. We'll work through it in terms of investment strategies. You do that then by, unfortunately, going for stock selection, as we talked about a little earlier, because it doesn't look like we're going to get this broad reignition of global growth anytime soon. I hope I'm wrong on that. I hope in a few months you can have me back and say, Ted, you were a little gloomy on global growth. It's booming. What's happened? Let's hope that's the case, because that would be the case that I'd certainly like to see. But it's not kind of the base case I would look at going forward here.
Ted, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Ted Dixon, CEO and co-founder of inkresearch.ca, his website, CanadianInsider.com. He was speaking to us from Vancouver. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Ted Dixon. And thank you for listening. If you have any questions for our guests or for the show, You can send them to info@howstreet.com. Now stand by for Company Showcase updates from American Manganese CEO Larry Reaugh and Naturally Splendid founder Craig Goodwin. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
It's always great to be on the show.
Larry, some people have expressed concerns about electric vehicle battery fires, and how does that relate to recycling those batteries?
Well, that's an interesting question, Jim. The battery fires made all the news back like in Boeing in 2013 when they had the fire, and they had a lithium cobalt battery. The reality is that back 5 years ago or 6 years ago, there was a lot more discussion about battery fires. And now we haven't seen a lot of it in the last several years, but now Tesla's had a fire in Shanghai, and I guess it was pretty spectacular. Now, one of the ways that a fire will start in a battery is when the battery cathode material is processed and made. It involves a lot of grinding and crushing and where you get a lot of metal particles. And I'm not talking about, handfuls. I'm talking about, parts per million, maybe 1 part per million. But that 1 part per million can get into a battery, and what happens is it basically makes a little hole between the membrane, between the anode and the cathode. And that's a short. And when that short happens, the battery blows up or catches on fire. And that particle is introduced through the process, usually the mining process. So when you look at our recycling program, just before I get into the recycling program, we had a process for lithium manganese batteries. And we had pretty clean material. It was a high purity, clean material. We made batteries out of it. And that's from the Artillery Peak ore. The resulting thing of that was that we didn't do any crushing or grinding, so there was less chance of introducing metal particles into the mix, and which made it a safer product to use. But that said and done, now that we're into recycling, and we've borrowed a lot of information off of the manganese process, and that should even clean up the cathode materials even further, so there'd be less and less and less chance of a metal particle getting into a battery. Not to say that it couldn't happen, but there would be certainly a level of safety in actually recycling than using raw material. So, I just wanted to mention that we have a process that once it's recycled, it probably has a much lesser chance of any kind of a short resulting in fires or explosions. And so, that's another plus on the side of recycling. And nobody wants to be, those cars, they're highly flammable once they catch on fire, or they can explode. And nobody wants to be caught up in that. So or have it parked underground, for example, and the battery catches on fire, and that can be a disaster for an apartment building or even an office complex or anything. Nobody needs a fire in the parking lot. Underground parking lot, I should say. So that is something I wanted to bring up, Jim. we have a process that has got some advantages. It certainly has a lot of advantages with recycling. You don't have to go back into mining to get the cathode materials to put into a battery. We get a high purity from the recycling, as we did in the manganese process, and that should eliminate a lot of these problems. So it just adds one more layer of the advantages of recycling. And certainly a lot of companies that are out there now, they're talking 10 years or so on a battery. That keeps getting bigger and bigger and bigger, and whether it's there's a lot of truth in that or not, I don't know. But it doesn't matter. They eventually end up in the recycle bin. There's enough to do for a company like American Manganese, it's a recycling program. Today, you don't have to wait 10 years for another batch of batteries to come free. They're coming free every year. And so it's another plus for recycling. It's just recycling is the way to go. It's socially conscious. It's a closed circuit. It's a cradle-to-grave solution, and it saves on having to open new mines or dealing with places like the DRC where you have doubtful quality in the material that you're receiving. So recycling is here to stay. There's a lot of interest in it. We're getting a lot of interest in it, and all we need is somebody to write that big check, and away we go. And we're looking at, perhaps looking at 50 tons a day because, it really depends on the results from the pilot plant, but I'm not seeing any major barriers. And so it's and the pilot plant is still scheduled to be finished by the end of next month, although we haven't really started on the stage 3 yet. And because we're waiting for a membrane, and because you got to remember now, as we patented the process, we kept developing new ideas that required new fabrications, and we're trying to top this off. We know we got another patent to file. We got one filed, and we should be hearing any day on that one. And it's just upward and onward for the company, Jim.
Larry, for people new about American Manganese, what are you all about?
Well, American Manganese is a critical metals company that started out as a manganese processing low-grade manganese in Arizona, which is the answer to a lot of the U.S. government's domestic supply for manganese metals or dioxides. And, we've just recently trademarked our process for recycling called recyclico.com. You'll be seeing more and more of that as we move through the next few months. And we are traded on the Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded on Frankfurt under the symbol 2AM. You can visit our site and get all the information. That a lot of the stuff that I'm talking about is on our site at AmericanManganeseInc.com. You can phone me at 778-574-4444 or just send me an email at LREAUGH@AMYMN.com.
Larry, thanks a lot for the update.
Well, you're welcome, Jim.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on April 26th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Craig Goodwin. He's the president and co-founder of Naturally Splendid. Welcome back to the show, Craig.
Thank you very much, Jim. Great to be here again.
Craig, what's cooking down at Naturally Splendid?
Well, we put out some news this morning. We have signed a letter of intent for some CBD toll processing. The letter of intent is with a Canadian company who has operations in Washington State. We are leasing our equipment to them that we recently purchased from Wahupta Ventures, and we believe this is delivering great shareholder value as we continue to watch the regulations around CBD extraction and around CBD edibles evolve here in Canada. This allows us to put our equipment into operation immediately and begin to capture shareholder value for our shareholders.
Now, those three letters have become almost magical for investors. Do people, and I use the word buzz in the proper sense, I think. Is there a big buzz when you say that's the industry you're in?
Absolutely. Well, you know what? We are evolving into a CBD edible manufacturing company. So we see many companies out there who have CBD extraction expertise, and there's also companies out there, of course, who have expertise in food manufacturing. But we believe that we bridge that gap, if you will, we connect the value chain where we understand hemp and we understand extraction from hemp. And we've also been a food manufacturer for a number of years now. Our facility in Pitt Meadows is SQF Level 2 certified. And that combination of high certification, expertise on the hemp side, and expertise on the food manufacturing side creates a value proposition that I think will deliver great shareholder value as that recognition becomes more well-known throughout the investment community.
Craig, for people who are new to Naturally Splendid, what are you all about?
Well, we began as a consumer-branded company. We had a number of hemp products in the market, the standard hemp seed, protein, and oil, but we began to evolve our strategic plan to include some science and technology, research and development. We began to understand there was much more that the plant could offer than just those basic three products. We watched the evolution of medical marijuana and recreational marijuana. And on the medical side, our main focus has been and will continue to be cannabidiol or CBD, those three magic letters that you've talked about. So we began to position ourselves in an area where we could deliver maximum shareholder value, and we believe that is creating, delivering, and distributing value-added products that are CBD-infused. Now, the regulations in Canada aren't all the way there yet, but the time to prepare for the regulations certainly isn't in October when we're expecting the new regs to come out, but the time to prepare was 3 and 5 years ago, like Naturally Splendid did. So we believe that we are positioned to capitalize on the evolving regulations to become one of Western Canada's go-to places when you want CBD-infused edible products. And this is how we have positioned Naturally Splendid.
Where are you traded and under what symbols?
We actually trade on 3 exchanges. On the Venture Exchange here in Canada, under the symbol NSP. We're on the OTCQB, and that symbol is NSPDF. And we continue to trade on Frankfurt, and that symbol is 50N. So we trade on all 3 exchanges, and you can also find us at our website, which is www.naturallysplendid.com. So there's great information there as well.
Craig, thanks a lot for the update.
Jim, thank you very much for your time as always, and we look forward to speaking to you again soon.
My guest has been Craig Goodwin, president and co-founder of Naturally Splendid. I'm Jim Goddard. Our conversation took place on April 24th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.